Hi, I'm Laura Valean, and you're listening to RICS Monitor, CP's quarterly podcast series that tracks sentiment toward real estate across the globe. Although there's little change from the previous quarter, the war in Iran and its effects are starting to show up in many economies. As usual, we'll unpack all the changes with Tarrant Parsons, Head of Market Analytics at the Royal Institution of Chartered Surveyors in London. Hi, Tarrant. Thank you for joining me again.
Hello, thanks for having me.
So at the global level, the headline commercial property sentiment index barely moved in the first quarter, but your latest reports suggest a lot is changing beneath the surface. What is the real story behind that apparent stability?
Yeah, so the headline number is a bit deceptive this quarter. As you say, the global index that we produced barely moved, and if you were to only look at that, you'd kind of reach the conclusion that nothing much happened. But that aggregate figure really does mask quite a bit of movement underneath. There's a rotation away from some previously stronger markets that are now feeling the effects of the geopolitical situation, and then some others that were a little bit more downbeat before, they are seeing some signs of recovery. And so those are kind of two offsetting forces when it comes to the global headline results. Where you can see a significant change this quarter, though, is the signal coming from the credit conditions indicator that we produce. I'm sure we'll get onto that later. But the overwhelming majority of the markets that we cover reported there's been a tightening in financing conditions during Q1. So beneath kind of a flat headline, the financial backdrop across the market has shifted quite meaningfully, it would appear, and that's usually the sort of thing that shows up in activity a quarter or two later rather than immediately. So yeah, steady on the surface, but it does seem to be more fragile underneath.
You mentioned the geopolitical situation, and the Iran war appears throughout the reports, but its impact is uneven. Which commercial real estate markets are proving most exposed to that shock, and why?
Yeah, I think the pattern is really about sensitivity to global energy markets rather than kind of geography necessarily. So the markets that have seen the most noticeable deterioration in sentiment, they all share one feature, which is kind of high exposure to imported inflation through energy price. So if you look at the UK as an example, seen a really kind of sharp rise in bond yields. Investors are now actually betting on interest rates being hiked by the Bank of England this year rather than some cuts that were kind of previously envisaged. And then on the other hand, you've got markets that the ones that have held up best to the macro impacts of this conflict. Places like Japan, mainland China, those are the ones that tend to have more contained domestic inflation dynamics. Of course, the UAE is experiencing a more direct impact from the conflict. The Gulf is right at the center of this disruption, and so it's not surprising that the data on the commercial property market there has seen a very stark reversal. It's gone from being one of our most upbeat markets to sentiment turning pretty cautious right now for understandable reasons.
You also mentioned earlier the credit conditions. They deteriorated in most countries in the first quarter. Is the credit environment now the most important forward indicator for commercial real estate values and transaction volumes?
I'd say it's the aspect of our results that I'm paying most attention to right now. Yes, that is the kind of main story. Historically, the credit condition series maps quite tightly alongside investment inquiries, and that in turn then feeds through into transaction volumes and ultimately values. The relationship, it isn't instant. There's a bit of a lag, but it is reliable enough to suggest that when we see a sharp move in the kind of credit conditions metric, it usually is a leading signal for what activity does over the kind of following couple of quarters. So when you see the vast majority of markets tightening in Q1, that's the kind of thing that it makes me a little bit cautious about the near-term outlook, even where current activity still looks okay. I wouldn't call it the only indicator that matters. Occupier fundamentals are doing a lot of work in the stronger markets, but as a forward signal for values and volumes specifically, lending rates, I think, carry the most information at the moment.
Let's dive deeper into each world region and start with Europe, where investment inquiries held up in the first quarter of the year, even as credit conditions weakened sharply. How long can investor interest stay resilient if debt markets keep tightening?
Yeah, that is a bit of a tension in the European report. So we have investment inquiries. They basically held flat in Q1, still marginally positive, but credit conditions for Europe, as elsewhere, deteriorated. So we're getting a clearly negative signal from that data. And so those two things don't usually sit together for too long. The historical relationship will tell you that if credit conditions, that indicator were to stay where it is, inquiries should then start to follow it down over the coming quarters. So that suggests the kind of resilience that we saw in Q1 is probably on borrowed time rather than being very durable. That is, unless the credit picture reverses in the next iteration of our results. But that would then require quite a quick end to the conflict, which has looked increasingly unlikely of late. So, investors can kind of hold their nerve for a quarter on the basis that the shock might be transitory. And you can see that in the anecdotal feedback. A lot of people effectively saying that investors are waiting to see how it plays out. But if debt markets keep tightening into next quarter, that wait and see stance tends to convert into actually kind of pulling back. And so the next survey is genuinely going to be more informative on that kind of activity.
hmm And meanwhile, North America shows a clear split. The US remains positive, while Canada is close to neutral but more fragile. What explains that divergence?
I think some of it comes down to how the energy shock is transmitting into each economy, plus a bit of domestic difference. The United States results, they did ease back slightly this quarter, but they're still comfortably positive. It's, a positive picture for their property markets, and the outlook for monetary policy there has not changed as dramatically as other nations at this point in time. And so I think the US is absorbing the shock from a position of strength. Canada's story is a bit different. So that actually its headline reading improved slightly. It's the least negative since 2022, but that was driven by strong occupier demand trends and rising rental growth expectations. If you look at the investment side, that's where the credit conditions indicate a flipped negative. That's for the first time in a couple of years. And the key difference is that Canada looks more exposed to the inflationary pass through from higher energy prices, and you can see as a result investment demand just starting to soften. That's across all three sectors there, even while the occupier demand series improves. So a real contrast opening up between the different sides of the rental side of the market and the investment side.
Although strong, as you said, the US seems to have moderated from a stronger last quarter, a stronger fourth quarter in 2025. Are you seeing a cooling market or simply a return to trend after an unusually upbeat quarter?
I'd lean kind of towards more of a return to trend rather than a significant cooling. That Q4 reading that you mentioned was particularly strong, well above kind of longer run averages. So the slight moderation this quarter, I think, is the market settling back towards where it normally sits rather than kind of rolling over. And a lot of elements of the latest data support that view. So investor demand, the data there, it moderated but stayed firmly positive, and importantly, the strength of inquiries broadened out across sectors rather than kind of narrowing, and that isn't something you'd expect to see if the market were kind of genuinely turning. So the one thing I'd flag is that there was an easing in the share of respondents viewing their market to be in the early stages of an upturn, but that was offset by more respondents placing the market in the kind of middle upturn phase. So the cycle perception is maturing, and so people think the US is a bit further into the upswing than before. So that is worth keeping an eye on, but it's still a long way from being a signal for a downturn. So for now, I'd characterize the United States as a stronger market that's taking a bit of a breath.
Mhm. APAC is still the weakest broad region, but sentiment there is the least negative since early 2023. Is that a genuine recovery signal or just less pessimism among
I think
respondents?
Yeah, I think a fair assessment would be to call it less pessimism, that's starting to maybe look like the early foundations of a recovery rather than just saying clear cut, it's a recovery at this point. The readings are still negative, so by definition, more respondents are still seeing some decline than improvement in a lot of variables, but the direction of travel is turning, becoming more encouraging. So the occupier sentiment index has now improved for 5 consecutive quarters, and occupier demand at the regional level has just turned marginally positive for the first time in 6 quarters. And if you're seeing, 5 or 6 quarters of incremental improvement, that isn't kind of noise, that is a trend that's coming through. So my take is that the worst looks to be behind Asia Pacific as a region. The components are moving the right way now, but I want to see those headline indices actually cross into positive territory and continue moving in that direction before I'd use the word a recovery without any caveats attached to it. Um, so right now, it's the least negative it's been in almost 3 years. That is a milestone, but least negative is and kind of positive aren't quite the same thing.
You said that Japan is the standout APAC market with very strong sentiment and buyer demand. What is Japan getting right, and are there risks that it is approaching the peak of the cycle?
Yeah, Japan is a real strong performer of late. The headline index continued to push up further this quarter. We're seeing investment demand. Our series there posted the strongest reading that we've seen in close to a decade. I think whereas a lot of economies are really worried about rising inflation, for such a long time, going back over decades, in Japan, there was a lot more concern around deflation. And so I think the current pricing environment, in some respects, is less unwelcome within reason. They've been battling against kind of staving off deflation, so a bit of price acceleration now isn't probably viewed the same way as across Europe, for instance. And rising rental growth projections currently are kind of tempting investors alongside what are increasingly robust occupier fundamentals. We see very strong tenant demand. On that peak question, yes, that's a fair worry. You can see it in the data. When we ask respondents where they think the market sits in the cycle, Japan does stand out alongside Singapore as the market where most people now are placing it at either at or near the peak. So fundamentals are very solid, but the cycle is maturing. And I think the specific risk flagged by respondents is that base rate increases as the Bank of Japan looks to normalise. If they were to exceed current expectations, that could take some of the shine off the market further down the line.
Mhm. But apart from Japan, India, Sri Lanka, and Spain are also among the more positive markets in the reports. Are they benefiting from fundamentally stronger occupier demand or from capital rotating away from more troubled markets?
I think it's mainly driven by fundamentals. India and Sri Lanka, they have amongst the strongest or kind of most broad-based expectations for capital value growth across almost every sector. And where there's such breadth in those positive expectations, that tells us there's real occupier demand and economic growth momentum rather than investors looking to chase one or two sectors. It's very kind of widespread. Likewise for Spain, it's consistently among the most upbeat European markets that we cover alongside Portugal. Economic growth has far exceeded that of the Eurozone more broadly over the past 12 months, and that is expected to continue through this year at least. There's also a bit of a rotation where I think capital is gravitating towards the markets that look most insulated from the energy shock. And Spain probably benefits from that, where electricity prices are far lower than many parts of Europe, and their wholesale energy markets are much more stable given their heavy investment into renewables in previous years. And that has successfully reduced their reliance on gas.
Mhm. And probably toward the opposite end of the spectrum, we can find China and Hong Kong that remain weak, but both of them show signs of becoming less negative. What would you need to see before calling a real turning point in those markets?
Yeah, both are clearly a lot less downbeat than they were. So that's certainly worth acknowledging. It's been a really prolonged run of negativity for their property market, so this is certainly an improvement. I think Hong Kong has posted its least negative headline sentiment index reading since 2023, and in mainland China, occupier demand has started to stabilize. There's less of an imbalance regarding the overhang of supply across the market as well. But the less negative story is not quite saying that it's kind of genuinely turning right now, and you would want to see a few specific things before calling it a more sustained recovery, a more clear-cut recovery. So the headline readings actually do need to cross into positive territory and stay there, not just for one quarter, but kind of stay there. And I want to see the improvement broaden beyond the more resilient pockets, because right now that the relative strength in both markets is concentrated on data centers, student housing, and the kind of prime areas of the traditional sectors. Some portions remain very weak. So I think a real turn would include more sectors participating in this pickup. But in Hong Kong's case, there is an interesting angle. Several respondents have kind of flagged that it could become a bit of a safe haven beneficiary if capital and businesses or investors move out of the United Arab Emirates while the conflict continues. So there's possibly an external catalyst there, but I treat that more as kind of speculative right now rather than something that's very concrete at this stage, but worth keeping an eye on. So overall, I think the trajectory for both Hong Kong and mainland China, it is looking more encouraging, but outright positive readings will need to come through and be sustained before you could say that we've definitely passed or moved away from the bottom of the market.
Right. One other thing across your reports that is very visible is that prime assets continue to outperform secondary assets. Is this flight to quality still intensifying, or has it become the new baseline for commercial real estate?
I think it's become the baseline, really. That's quite an interesting point. So, for a few years, the real prime versus secondary split was the narrative everyone was looking at, and it was actively widening. I think now it's so consistent across every region, every report, that it's less of a trend to kind of to look at. It's more just the structure of the market. So prime industrial, prime retail, and offices, they're holding up, posting some positive projections in a lot of markets, but secondary office in particular, that is the one segment sitting very clearly negative in so many cases. So I'd frame it kind of this way: that flight to quality has kind of matured now. It's less of a flight into, now it's more of a permanent preference. And so the question for the market is no longer, is quality outperforming? That's quite clear it is. The question's now kind of what happens to all the secondary stock that's been kind of left behind.
Right. And some respondents suggest recapitalization and refurbishment could revive activity in this sector in secondary office. Where do you see opportunity in distressed or obsolete office stock?
Yeah, it's a kind of an interesting area where some good value opportunities could be on offer. I think it was reported that in the United States, the volume of distressed office assets changing hands last year was double that of the previous year, and so some sellers took kind of heavy write-downs, and you saw institutional buyers step in cheaply. I think there was a deal in New York where distressed tower kind of drew close to $500 million in financing to convert it to housing. So I think it's for well-located buildings where there's a gap between weak valuation and a really viable future use. Either that could be refurbishment to grade A office standard, or perhaps conversion to residential or another use. That's where there could be opportunities, but not all stock will be suitable for conversion or so easily. And so I think investors have to be very wise in selecting particular assets rather than just looking at any secondary office stock to repurpose.
And meanwhile, data centers are grabbing headlines all over the place, and they're consistently among the strongest projected asset classes across Europe, APAC, North America. Is this sector still underpinned by fundamentals, or is there a risk of over-exuberance?
And I think that the fundamentals are absolutely real. So data centers display the strongest growth projections of all real estate asset classes in basically every single region and country that we cover. And in the United States, the expected capital value growth was actually upgraded this quarter, despite everything else going on externally. And so that's, it's underpinned by genuine structural demand, the AI build out, cloud, the whole digital infrastructure story. And I don't think that demand is going away anytime soon. So it doesn't appear over exuberant from that angle. But I think any time when you have a single sector that is the consensus top pick across every region simultaneously, that is the type of the type of conditions where expectations can run ahead of what assets can actually deliver. So I think that the risks from that kind of from that view, they are need to be considered. You've got power availability constraints. You've got the pace of construction for all these types of these assets, and then you've got the question of whether AI-driven kind of demand assumptions hold up if that cycle begins to cool. So I think the answer is fundamentally it's very well underpinned. I would push back on anyone calling it the kind of pure exuberance, but it's also the sector where you'd need to be most alert to that potential gap between projected returns and what will be delivered, simply because everyone is kind of crowded into that same bullish stance.
Right, right. And looking ahead to the next quarters, what would make you more confident that commercial real estate sentiment is moving from stabilization to recovery? And what would make you worry that Q1 was the start of another leg down?
Yeah, I mean, it could still go either way. I think the thing that would genuinely move me towards feeling or calling a recovery is that credit picture reversing. I mean, if the next survey or two show financing conditions stabilizing or improving after this quarter's very broad tightening, I think that removes the single biggest overhang and lets the more resilient occupier fundamentals actually come through and drive activity. On the more cautious side, and perhaps this is growing, if the Iran situation persists and oil prices stay elevated for a prolonged period, I know they've come back in the past week, but they're still very volatile. So that will feed through into inflation, and the risk is that it could trigger second round effects. It's not just pure oil prices is what that will feed through into, talking about fertilizer as well, struggling to get through out of the region, and so will that affect food prices down the line? Lots of things to consider, and that would keep central banks from being able to cut rates. You'd see bond yields staying higher, and the credit tightening that we saw in Q1 would in all likelihood deepen rather than reverse, and that's the sequence that would turn this from a bit of a one quarter wobble into perhaps the start of another leg down, because there are a lot of wait and see investors seeing how it's all going to play out, but if it does look like it's going to be a bit of a prolonged disruption, they'll start reconsidering where else to deploy capital. I think maybe in the bond market if there are good returns on offer there. So I think the occupier resilience that's holding the numbers up now, if we were to see really strong inflation numbers start to come through, that would erode some of that resilience in the face of what would be weakening real income growth. So both the upside and the downside risks, I think, hinge on the same thing, but predicting what will happen with regard to the conflict is still incredibly difficult.
Thank you, Tarrant, for another insightful conversation.
Thank you very much.
Thank you for listening. If you enjoyed this episode, please take a moment to rate and review the show on your favorite podcast platform. It really helps others discover us. And be sure to visit cpexecutive.com for the latest commercial real estate news, trend stories, and insights from industry leaders. And while you're there, check out our new newsletter, Sneak Peek. Subscribers get early access to exclusive insights, data-backed analysis, and expert commentary on the deals, trends, and market shifts shaping commercial real estate. You'll find more details and the subscription link at cpexecutive.com. Till next time.